It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at TOKEN2049.
Happy Monday out there, and welcome to another episode of Macro Mondays. My name is Mikkel Rosenveld, and as usual, I'm your host, together with my partner, Andreas Dino. Welcome to you, Andreas.
Thank you. Get the hell out of Europe. That's the headline.
That's the headline of the script here. That'll be the headline of the episode. We'll talk more about that. I have one question for you initially, Andreas.
Yeah.
Do you eat ramen food?
Well, occasionally, but never in Denmark.
No.
Maybe in London.
We'll get back to that a little bit later. We've been roasted as well for that. Maybe a little more into French cuisine. We'll be covering the French election chaos a little bit later. We're going to be talking U.S. inflation, obviously, and we're going to be talking about freight rates and copper once more. We have a lot of takes on that.
Yeah.
Later on in the show, we'll get to some trading topics, some changes to our portfolio. We have a lot of great user or listener feedback, so please do keep sending us your best memes, feedbacks, ideas, criticism, whatever, charts, whatever you want, and we'll pick and choose what we like from that and use in the show. So, Andreas, should we start with the U.S. inflation? You were caught a little bit off guard, perhaps.
Thanks for mentioning that, Mikkel. I guess that's been the sort of main trading topic of the past week. We've seen soft inflation numbers, both in the consumer price index, but also, and maybe more importantly, in the producer price index released the day after. Our thesis of a spillover from the Red Sea malaise to consumer prices and producer prices in the US is it's getting tested here. Let me be honest about that. When you look at the producer price index, we actually saw quite some weakness in the consumer goods category, which is typically the category that you would expect to see a rising trend in when you see freight rates on the rise. That basically what we've seen over the past 6 months, right? So apparently those freight rates are not passed through to consumer prices and producer prices right now, which is a bit of a puzzle to me. So let's see whether we get some early signs of that goods-free inflation in June and July. We have admittedly seen signs of that goods inflation elsewhere, but not in the US. That's interesting. When you look at the consumer price index, and I want to show one chart in relation to that, the major downside surprise, which in turn is pretty good news, was the deflation month on month in the price of motor vehicle insurance. And we've been accused of being boring in this show over the past month, and now I'm sitting here talking about motor vehicle insurance costs. But this category has been moving out of the ordinary, say over the past year or two, probably as a lagged consequence of higher discount rates, the extreme supply chain issues we had in the auto sector through 21-22. Remember the times where the price of a used car went up month after month, right? You know something is wrong when the price of a used car goes up. I mean, that's it's basically a given as soon as you put the key in that the price drops, right? But it did do that through 21-22. And this is kind of a lagged consequence of that. But all of a sudden, the insurance cost dropped 0.5 percentage point in a month. And when you look at our model, we've been waiting and waiting and waiting for that disinflation or maybe even outright deflation in insurance costs. And here it is. And that's potentially a game changer. I have to admit that, because this has been one of the main cost categories keeping the upside pressure in the consumer price index intact. And here we are with a change of scenery, potentially. As you can see from the chart here, it's likely, given this production to inventory to sales cycle in the auto sector in the US, that we will see continued disinflation in this insurance cost category. That's good news for the Fed. If we add disinflation from the housing sector, still debatable in my view, then all of a sudden there's actually a potential scenario where the Federal Reserve will have to revise inflation forecasts down for the first time in quite a while. They revised their inflation forecasts up last week, and they revised these inflation forecasts up alongside removing a few interest rate cuts from their projections this year. So I guess it's kind of simple mechanics in a way, that if they start moving in the other direction of on their inflation forecasts through the second half of the year, we may move towards those cuts that we've been longing for, more or less, right?
Yeah.
You want to unfuck your shit?
This is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
Enough about insurance, Andreas.
Yeah.
We held a keynote yesterday at a major Danish insurance company, and even they didn't find this chart interesting. So let's move on. No, I'm joking. Yeah. Let's move on to this chart. I've been waiting to show this to you listeners out there. This is, I think, one of our flagship products at Stena Research. I teased about it 14 weeks ago, and then we didn't even mention it last week. So sorry about that. But here you go, our macro regime indicator. And Andreas, before we get to digesting all these arrows, could you just put some words into what is our macro regime indicator?
So what we basically do here is that we now cast liquidity trends, inflation trends, and growth trends via daily observations. And then we map that in a regime model. If inflation goes up, liquidity goes up, and growth goes up at the same time, we're in this up scenario, which is decently positive, by the way. But my main takeaway from the last week here is that I actually see the balance of risks tilted towards the regime moving even one notch higher.
To gung-ho.
To gung-ho, Goldilocks, call it whatever you want.
With inflation changing direction.
Yeah, with inflation changing direction towards a negative arrow here. Which in turn is positive. I mean, gung-ho is obviously refers to this Chinese saying, and gung-ho basically means take as much risk as you like, right? And liquidity goes up right now because of a change of scenery in the T-bills issuance into the latter parts of June and especially into July. So we'll get positive liquidity trends in July. Because of a larger T-bills issuance, emptying that overnight reverse repo facility that we've talked about over and over. Growth looks pretty decent into July still. Our congestion-based data is solid. So we have loads of people in airplanes, loads of people on the roads, loads of trucks on the roads. The only pocket of weakness right now is actually shipping. And that's the major sort of shift of trend that we've seen in our nowcasts on growth over the past 2 weeks, that we see early signs of shipping rolling over. In turn, once again, good news for the inflation story, since those elevated freight rates may start to move a bit in the other direction towards lower rates, right?
Absolutely.
So by the end of the day, what I'm saying here is you probably need to remain positive.
Absolutely.
Yeah.
I really like this macro regime indicator. It's specific and simple enough for me to understand, even as a non-economist. And the reason why we also show it in this show is because this is at the core of much of our thinking and analysis here at Standard Research. So it's really important to understand, and we'll try and draw it in to make things really specific and concrete. I'm hoping we go into gung-ho territory, to the monkey JPEG territory soon. We'll see about that.
Mikkel, let me ask you about the second main trading topic of last week. We've seen more or less a meltdown in the CAC 40, the French equity index. We've seen wider spreads between French govies and German govies. And it all boils down to the question of whether the right wing will gain some momentum and some power in French politics. So fill us in on this election chaos in France and the soap opera currently unfolding.
Yeah. I mean, this obviously all started on Sunday after the European Parliament elections, where President Macron called for snap legislative elections in France. So this is not an election for the presidential office. This is compared to elections for the Senate and the House in the US, basically, or the House specifically. And this caught all the major parties in France by surprise, seemingly. Perhaps not his own, but and now what we've seen over the past few days has been sort of a scrambling to get ready for this election. Usually, you have these cycles. You wait 5 years, and then you form alliances, you form elections, policies, etc. But now you basically have a couple of weeks to do all this, and that's caused absolute chaos. Starting from the left quickly emerged from negotiations with a united Popular Front, Front Populaire, which already seems quite well organized. So they will be a factor in this election. The center is obviously centered around Emmanuel Macron and his Renaissance Party. That's also really solid. But the right wing is a complete mess right now. This guy, Eric Ciotti, is the president of the good old Republican Party. That's the party of Chirac and Sarkozy, the old Gaullist party. And they apparently had no plans for a snap election. He's the president, so the chairman, so to speak, of the party. And he initially declared that he wanted to enter an alliance led by the right-wing Rassemblement National, the Le Pen party. His own party, big parts of his own party had none of that. They didn't think he had the authority to make this decision. They tried to oust him. He tried to physically barricade. He locked all the doors of the party headquarters, and they had to get in board members to open the doors and get him thrown out. And right now, that the main center-right party, or the old main center-right party of France, is in complete meltdown mode. I think the right-wing party of Le Pen, shown to the right in this, will basically pick up the scraps from this. They will also pick up the scraps from Eric Zemmour, whom you might remember from the last presidential election. His party is also in complete disarray over the links and over the sort of, should you kneel to the leadership of Le Pen as the French right, or should you remain an independent party in this? So basically, we are seeing a three-horse race building up. Why is this affecting French equity so much? Well, first of all, when you have a three-horse race like this, you're very likely to get a hung parliament once more. That's what Macron tried to alleviate by calling these elections. The previous parliament was almost in a deadlock politically. I don't see any of these parties either getting the majority of themselves or being able to work together very productively. So you will have more or less a 30-40 parliament, perhaps. And that's not very conducive to economic reforms and reacting to economic needs of France right now. Especially when you have a president like Macron, who is entering his sitting duck period, who will not be able to stand for re-election next time. So that's the one thing. That's the short-term driver of this. The long-term driver of this, and that's perhaps where this gets even more interesting, is that around the world, investors are very, very scared of the Le Pen scenario. Even though she might not win this election, this will be a very, very good stepping stone for the next French presidential elections, where she is perhaps the main favorite right now. And especially perhaps in Asia, and I know we have a chart on this, investors are scared of the right-wing scenario in a country like France. This chart shows the Japanese holding of French government bonds. We pointed out the Le Pen scare of 2017, and we might see something similar.
Yeah. It was basically the first time where she feasibly entered the limelight as a presidential candidate, right? She lost in the second round against Macron, but did pretty well. And she obviously ran against him again in 22. But I guess you're right that this time the scenario is even more feasible than it was in 22 and 2017. And I'd like to share a bit of anecdotal evidence around this because let me just put it out there. I mean, I don't fear this scenario. I think it's overcooked as a risk scenario, but the Asian investors do. And when I ran the macro strategy team at the biggest northern bank in Europe, Nordea, we had a lot of meetings with the Chinese central bank and Japanese investors after, first of all, the 2017 election in France, but also after the elections in Sweden, where the right-wing party, the Sweden Democrats, suddenly gained like 25% of the votes. And I had quite literally to show a diagram of the various parties and point to the fact that even though they got like 25, say 30% of the votes, the 70% left, whatever it took, wanted to keep them out of power. Yeah. So they basically annulled their votes. And in Sweden and Denmark, where we're situated, we have a long history of minority governments, which is a concept you don't really see elsewhere on Earth. Yeah. So I even had to explain these Chinese and Japanese investors that, well, this minority, say 35% of the diagram, they rule. And they were like, that cannot be true. I mean, they couldn't get their head around that concept. It's kind of the same here with the French election. And at least if we take 2017 and 2022 as anecdotal evidence, it seems like the French voters, when push comes to shove, decides to unite around a non-Le Pen candidate. Yeah. Say in a 60-40 scenario, 55-45 scenario, something like that. That could very well happen again in a few years.
Absolutely.
And so my point here is the Japanese investors, they get scared when they see this on the front page of FT or the Wall Street Journal. But it's not necessarily rational, in my view. But again here, and I mean, that's why we've labeled the show this week, Get the Hell Out of Europe. You don't want to fight the tape here. You don't want to fight the trend from these Asian investors. They're big, and they're told by their bosses to exit Europe because of this risk right now. In turn, this is very positive for the U.S. equity market because if you sell French stocks and French government bonds, you need to buy something else.
Absolutely. Let's turn our attention to Asia itself a little bit. Yeah. I want to draw this chart of the freight index and export prices out of China. How do you see Chinese inflation or even deflation working out right now?
I mean, it's not a secret that China has exported disinflation or maybe even outright deflation to Western markets for a while. It's been a crystal clear part of their strategy to try and keep prices down to gain market shares. And they've sort of internalized that weak profit cycle within the sort of state capitalism that they run. And I think they're running into major issues with this strategy right now. We're obviously seeing tariffs being put on Chinese EVs right, left, and center, basically throughout the West now. Even the lame duck European Commission has now decided to put tariffs on Chinese EVs. So this strategy of just subsidizing the price of quote-unquote private companies, it doesn't really seem feasible given this tariff war, right? So maybe the next step for China is to try and do what we've done in the West, try to actually create value and try to come up with products that are better than those we're able to manufacture in Europe and to a certain extent in the US. I mean, I'm not necessarily convinced that a tariff on a BYD EV is enough to keep them out of Europe.
No,
because they're actually pretty good.
Yeah.
And I guess that's the next question here. If they keep selling these cars, but at higher prices because they're good cars, this is inflationary all of a sudden. And that's kind of what I fear here, especially for Europe, since China is not really able to sell any cars in the US right now. Could this turn out to be an inflationary story rather than the opposite? We basically had the opposite view a couple of months ago. Yeah. I'm not convinced that we'll be able to keep Chinese cars out of Europe.
No, absolutely. What we'll get back to the EV tariff a little bit. Just one point of it. What the EU is trying to do here is very specifically to target car manufacturers that are state backed. So they're basically trying to put a heavier price on the Chinese state interfering or subsidizing these car manufacturers. So if these car manufacturers, first and foremost, if they engage in negotiations, engage in a dialogue with the European Union, they can get these tariffs down. And even if they persist, which they probably will do, it basically just raises the price for how much subsidy the Chinese government has to pump into this.
Yeah, you could argue.
That's the most interesting part of that EV story is that this is the first drop in the bucket of this potential trade war between the EU and China, and it's being overlooked. It's very interesting that this occurred only 3 days after the European Parliament vote. It shows you exactly how important the Parliament is or isn't. We'll be covering this over the coming weeks, but a little word on Chinese copper. We've been talking so much about copper in China. It seems like the as we show in this chart that the copper consumption is taking a nosedive.
It is, and it is in sharp contrast to the consensus. Let me just emphasize that. So take a look at this chart. Through the early innings of the year, we had a very sharp increase in the actual consumption of copper in China, probably related to this EV solar panel wind turbine wave that we've seen export-wise out of China. With the addition of tariffs from both the US administration, now the European Union, it seems like the momentum has faded quite substantially on that export trade right now for China. Let's see where this ends up in 6 months from now. And if you look at new constructions in China, we're absolutely on the floor in terms of construction activity. We're talking 2008 levels. So this is the country that typically consumes the most copper on Earth. We're talking 50% of the total copper consumption on Earth. And we're currently, in our nowcast, seeing a drop of, at the very least, 20% year on year. And the dotted scenario here is a scenario where they keep inventories as elevated as they are now. And that basically means probably an even larger year-on-year drop in their actual consumption. So the whole story of China building up copper inventory through the early innings of the year, we were early on that. We traded it. We won a lot from being long copper. Now I'm getting scared as fuck that it was a false flag. Yeah. And I have to admit that I've basically made a complete U-turn on this story because of our live data on the actual consumption. So if you remove the inventory buildup from their consumption statistics, you get to this number of a sharp decline year on year all of a sudden. And it's basically been happening over a couple of weeks, this, or at least at the max a couple of months. And I think China's making a fool out of the Western metals speculants here because locally in China, I had a lot of discussions with metals PMs in the West around that early in the year. the local hedge funds, the local funds in China, they were super long copper through the early innings of the year. They've now flipped, while the positioning in copper among macro hedge funds, etc., in the West is extremely clustered in that July contract. So they're still long, despite this. I think it ends in tears.
Yeah.
Let me put it like that. I'm scared of a major drawdown in copper here.
Yeah. And perhaps this is a lesson to be aware of how the Chinese government, or perhaps more specifically the local governments, can manipulate such a big market as copper.
Yeah.
A very, very interesting case. We'll be covering that as well. Before we get to our trading topics and the listener feedback, let's have the clip of the week. We're not doing a Trump clip this week. We're doing a Biden clip. This is from a concert at the White House, I believe, where Biden glitches basically in the crowd. Yeah, so let's have it. Oh, this is great.
Yeah, I mean, you're not supposed to laugh, right? But it's just hard not to.
Yeah.
The only one I'm kind of missing Mitch McConnell here. Freezing Mitch.
Exactly.
He would have looked lively with alongside Joe here. But,
oh my God.
Mikkel, let me just. I mean. Yeah, our clients and those who know us, they know that we have a very cynical take on this. Is it too late for the Democrats to get rid of Biden? I mean, it looks like he's kind of lost.
It does, and it's not too late.
Yeah.
And that was kind of my point on Twitter last night when also the images of the videos from the G7 meeting in Italy emerged of him looking completely confused, and we're getting a handful of these videos each week. Over the summer, and my point there was, I'll get back to the Democratic Party. My point there was, when you have a sitting president, his term runs out in January, this can be managed. I mean, it's a little embarrassing. People might start to get the idea that he is confused all the time. That can be managed. He'll be out of there in January. His policy is set. His team is up and running. The question here is this man the right man for the next 4 years? I'm not talking his policies here. I'm simply talking about his capabilities. And I think this talk it has to be ongoing in the Democratic Party. The deadline, or the practical deadline, will be the convention in August. That's where they formally elect Biden as their presidential nominee. That is where you would that's what you would see as the deadline to oust him. What would it take? Well, it would basically take either that he realizes this himself and drops out of the of contention, or that he's pushed to that decision. We don't know if Biden has these thoughts himself. We don't know how much he's managed, if you know what I mean. So we don't know how many people could potentially push him to this decision. There's also a question is about whether they dare this. Do they dare to push? He won the primaries clearly. So do they dare to push him out this close to the election? I think it's a matter of how much they can keep him hidden from the public over the summer, basically. And then we have a scenario of perhaps getting him elected and then looking at who's the vice president and getting him in there. So this could also be in the shape of a vice presidential battle going on behind the scenes, because
no Kamala.
It's going to be tough to pull her out of the ticket, but the discussion has to be there, because a lot of voters will go out there and think, and it will go out with the Sarah Palin analysis back from 2008. I mean, if Biden dies, it's Kamala, and there is a significant risk that Biden dies or has to step down over the next 4 years. So they're basically voting for Kamala, and that's not a very good selling point for voters. So, to summarize this, I think there is a chance that the Democrats show up for the general election with another candidate than Joe Biden. I don't think he will resign in the middle of his presidency. I think he will sit it out. But there is a significant chance that they will tell him that he has to step down, and then we will see some kind of brokered convention where the establishment of the party will present a unified candidate. Probably not Kamala Harris, in my opinion. We'll get back to who that might be.
Gavin
is probably the best bet right now, even though he's not a very good bet either, because who wants to elect a Californian for the presidency? So that's also the point.
Sorry to the Californians out there.
Who else?
Yeah.
I mean, this is a possibility that we need to keep our eyes open for, and obviously a incredible game changer in the upcoming election.
Yeah.
Mikkel,
let's move ahead.
Let's move ahead.
We're getting into the weeds of U.S. politics here.
Absolutely.
I completely get if you're sitting out there in California or in D.C. or whatever, where you're situated, looking at a couple of Danes discussing U.S. politics, thinking, move on. So we're moving on.
Absolutely. Trading topics for the week ahead, Andreas. You're looking at the emerging divergence between UK and European inflation.
Yeah.
What's the point there?
I always love when you say UK versus European inflation. Yeah. They're still a part of Europe, just not the Union.
Depends on who you ask, yeah.
So a very swift comment on that. We track wage growth in job openings in the UK versus the Euro area via this Indeed Lab indicator. We're talking a divergence of size now between the UK and the Euro area. So the wage growth is extremely sticky in the UK, despite no real growth in the economy. I guess this is sort of a symptom of Brexit to a large extent. It's trickier to recruit and all that, so you simply need to pay up. And it leaves the Bank of England with quite the headache. How do you manage an economy that is not growing, but it's basically stagflation, right? More or less, we're talking here 7% wage growth with no growth in the economy. That's quite the headache. So the point here is that don't buy fixed income in the UK. I really dislike that trade. While I'm much more in favor of buying fixed income in Europe, at least selectively. Don't buy it in France right now, maybe in Germany. As long as we don't have any obstacles in German politics, I don't really see them around the corner. So that's the short version here. We get the UK inflation numbers in the week that we're entering here. And they will likely look ugly again. That's what I'm saying.
And what's the angle on the EV tariffs we talked about earlier? It seems like Tesla has been the big winner so far, even though they do manufacture a lot of their cars in China and get their batteries manufactured out of there. Yeah,
but at least they do assemble some of the cars in Berlin.
Yeah, exactly.
So for now, it seems like Elon is a happy man. More or less caught in the middle of this tariffs war, but I guess his biggest competition came from the East, and that competition is sort of kept away to a certain extent now. He even won the vote on his massive package on his salary. So $50 billion, wasn't it? Wasn't that the number?
That's not too shabby.
So he can buy a few Teslas himself as well if he needs to. In any case, I think Tesla is a super bet here.
Yeah.
I have to, and I know all of the issues around their self-driving car technology and all that. I think it's debatable whether they are as much ahead of the competition as they claim to be. But this current scenario, in terms of like short-term delivery numbers, short-term sales numbers, it's good news for Tesla.
Yeah. So just to sum up our trading portfolio right now, going short in copper and silver still.
Yes.
Putting some risk on tech and crypto.
Yeah.
Some liquidity bets.
And Tesla consumer discretionary products in the US. Yeah. We dislike Europe.
And then get the hell out of Europe, as the title says. Especially France.
Get the hell out of France. Yeah. Not if you're a tourist, but but from an investor perspective. I love France.
Absolutely.
I've never loved France from an investment perspective, but no. It's a pretty country.
Yeah, don't buy their cars either. No.
Yeah.
No, not at all. Now that we have begun talking about our macro regime indicator, we are opening a can of worms because we've been doing this for over a year, and people can obviously track back on our website and see how we've done. And we got some user feedback from how we positioned the macro regime indicator back in Q4
last year. Yes.
Yeah, last year, obviously. Hi, Andreas. This is from a listener. Hi, Andreas. At the end of October, you forecasted that the stock market would go down, but instead the stock market started a huge rally. At the end of November, you forecasted that after the Fed meeting in the beginning of December, the stock market would go down, but instead the rally just got wilder. What went wrong? And this chart shows the macro regime indicator back from early December, which would put it gung-ho.
Yeah. So thanks for that question, Arne. I think he's right to a certain extent. So in October, after a few months of very, very weak returns in equities that we had right, we were too late at reversing the macro regime indicator. I agree. So I guess this underscores the importance of being structured around such a process because as we have on the screen, we moved from a very lukewarm scenario in November to full-on risk in December. So we jumped the bandwagon already in December, but it was a month too late. I agree. So when you're structured around such a process, you're not fundamentally wrong for quarters in a row. You're wrong a month or maybe a couple of months max. And that's the importance that I want to underscore from this macro regime indicator. We track this as often as we can. Every time there is a data update, we track it, and we obviously monitor the developments daily. So when you see a turnaround in liquidity, which was basically what happened on the back of that Fed pivot in Q4, it takes a few weeks before the regime fully updates to that reality. But you will be the second or third in that trade, but you're not the first in that trade. So we're not trying to look quarters ahead in this macro regime.
No.
We're trying to look at what's happening right now and here.
It's much more short-term.
Yeah.
Than that,
Fair feedback, and thankfully, we've made tremendous returns since that flip in the regime by late November, early December.
Talking about long-term, Andreas, possibly the ultimate way of expressing yourself being long something is to get a tattoo in the forehead of, here is Solana. This is our user meme, listener meme of the week.
I got that in the inbox. and the message that followed, we're seeing a guy called Lil Pump with a Solana tattoo on his forehead. The message that followed from the viewer was, is this a sign of a cycle peak in Solana? Yeah. I'm not an expert in Solana, I have to admit that. But I guess it's the kind of anecdotal evidence you're looking for to short something. Given what we've said about the gung-ho risk regime into July, etc., I think crypto will do pretty well. Mm-hmm. But maybe Solana is a bit overextended here. I don't know. At least this is kind of the sign.
Yeah. And then let's round off with the meme of the week. This is also from a viewer, and we have to take this in as Danes here. Obviously, the comparison of these are they called Shiba dogs? I think. Yeah. Danes in 824 AD, we will crush all who opposes. We fear no man. Thor be with us with a Viking helmet, obviously. And then Danes today, help noodle burn my mouth. A story came out that a Danish supermarket had stopped selling, I think it was chicken ramen noodles because they were simply too spicy for our Western taste buds, or Nordic taste buds.
That's why we keep this show at 35 minutes, because I have to run for the toilet.
Absolutely. Yeah. So thank you all for joining out there. Remember, if you're listening to this in podcast, you can view all the charts that we talk about. If you view the show on YouTube, it's obviously all up to you. You can check out both versions as well. Not much left to say other than thank you for tuning in. We'll be back next Monday.
Yep. Thank you.
Thank you.
Sometimes it may be good, sometimes it may be shit.
It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at TOKEN2049.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.